Hi, this is Joe Lopresti. Welcome to our latest Arlington Wealth Management Proactive Strategy Update for Friday, February 24th. Well, since our last update, some of the trends that were in place the latter part of 2022 into the early weeks of 2023, as we got into February, kind of stalled. And in the last couple of weeks, they've hit a bit of a reversal. So today I want to discuss what's the primary cause of the hesitation here in the uptrend that began at the end of last year. We'll look at our proprietary indicators and models, and then we'll conclude by looking at our economic model, as there's some new developments there that we wanted to share with you today. So I want to start today by looking at interest rates, and then we'll take a look at the latest inflation numbers, because that seems to be the primary cause of the reversal in the market. Interest rate expectations have taken another step higher as some of the inflation numbers came out in February, which were stronger than expected. What we're looking at is short-term interest rates. So the gold line is the effective federal funds rate. That's what the Federal Reserve controls. We're going back 3 years, so you could see after the pandemic, they brought it down to zero, held it there for a lengthy period of time, and then started to ratchet up interest rates. As we got into this year, you could see the last interest rate increase was smaller than the previous ones. And that led to the market making an assumption that the Fed is beginning to wind down their interest rate increases. The purple line is the market's short-term interest rates, and you can see basically follows the same path. Now I want to overlay longer-term interest rates. This is the 10-year Treasury bond rate in the purple. And this is a market-based rate, not necessarily controlled by the Fed, but by supply and demand in the bond market. And we could see that this was generally following that upward path until the last quarter of last year. We hit a peak and it started to drop. And that's where the short-term interest rates and longer-term interest rates began to diverge. Well, the reason that's important is the longer-term interest rates oftentimes will pick up what the future Fed movements, meaning that they would expect a potential softening in the economy, and therefore eventually the Fed will have to reduce interest rates to spur the economy on. And it was really this decline in interest rate, longer-term interest rate expectations, which are correlated with the inflation expectations, that began to put a bit of support underneath the stock market and in asset prices in general. So we could see beginning in February, there's been a bit of a reversal of the downward movement in long-term interest rates, and there's been an uptick in those long-term interest rates. That's put renewed pressure on stock prices. It was really the upward swing in interest rates here through 2022 that caused the bear market in 2022. So a question to ask now is, this latest movement up in interest rates, is it a resumption of a longer-term uptrend in those long-term rates, which would not be a good indication for the future path of the stock market? Or is it just a bit of a blip up and the interest rates are still going to be in a downward trend as we go through 2023? That would be a very positive development for the stock market through the rest of the year. Now I'm going to add the dollar index to the chart, which has a very high correlation with these interest rates. And you can see the blue line is the dollar index, which peaked right about the same time that the long-term Treasury rates did. And as long-term Treasury rates dropped, the dollar went through a sizable drop at the end of last year into the early part of this year. And now it too has bounced up a bit. And that puts pressure on certain types of assets that are priced in dollars, like commodities and commodity-related equity prices. So if we take those short-term rates off, we could see this is really the correlation that's taking place in the market. The decline in interest rates from, say, 4+% down to the 3, the threes and now beginning to inch its way back up to 4. The decline in the dollar and now the recovery. Is this recovery a new long-term trend in place, in which case we would expect the stock market is going to begin another leg down? Or is it just a short flip up in what's a longer-term decline in interest rates and the dollar, in which case we would expect the stock market to continue to move higher throughout 2023? Now, why are interest rates beginning to trend higher beginning in February when they were coming down coming into this month? And the answer is that inflation, which was declining at a pretty quick pace, both the consumer price index, the personal consumption index, these are key inflation measures that is tracked by the Fed to make their interest rate decisions. And what we see is February numbers, things have leveled off a little bit, and even a bit of an uptick in the personal consumption index. So market participants are now expecting maybe the Fed isn't going to wind down their interest rate increases quite as fast as was expected before these February inflation numbers came out. And if the Fed is going to continue to ratchet up interest rates higher and longer than was previously expected, that, of course, is a valuation suppressant on stock prices. And essentially, that's why the stock market has stalled in February and has reversed. So with that being shown, the real question today is this reversal longer term in nature? Is this a resumption of the bear market that was in place throughout most of 2022? Or is this just a little bit of a step back after the stock market made a pretty good move from, say, the low in October last year up to the high a few weeks ago? Well, let's take a look at our proprietary market model to see what the indications suggest. So here's our PAS dashboard, and essentially there hasn't been any meaningful status changes in any of our indicators yet. It's going to take more than 2 or 3 weeks of a pullback in the market to cause that to happen. We really want to focus here on these core indicators because those are the primary determinants of the market cycle. That led to the global buy signal November 30th last year. And you could see as of right now, still all 3 of these indicators are showing a green arrow, meaning a positive status. So we're not seeing any material deterioration with these indicators yet. Now, if this downtrend continues in the weeks ahead, that certainly can still develop. But as of right now, it's just not showing up in these models. So let's look at one good example. This is our universe trend indicator. And, we have the 2 different versions of it, the logarithmic and traditional scale. You can see the bottom in both of these October, September of last year. And the upturn took place in both in November, carried through really to the early days of February, as noted by that 2 there. And these are still holding on to their high levels. So even with pretty good pullback in stock prices in February, we're not seeing any deterioration. In fact, the logarithmic version is still at its high of 58%, 58.39. No pullback to speak of. The traditional is off a little bit from its high of 52, but is just a little bit below that. So this measures the breadth of a very broad number of stocks globally, and we're not seeing any material change of trends, long-term trends in those individual stock charts, which right now is a good sign. Now that could still develop, as I said earlier, over the following weeks, but today we're not seeing any evidence that this downturn is developing into a major new leg down in the market just yet. And now turning to our cash comparison charts, these you could see the pullback in the market last year, very evident. The rebound that again started in November through February. You could see the high in this rising X column happened very early in February. And what's important here is that both of these charts came right up to their previous high, which was last August. As the market was declining, there was a bit of a movement up during that time, and we came right up to the same level and it stalled. So it would have been very positive to see this continue to follow through and break that August high. That didn't happen. We now have the stall in place, and you could see the numbers, which were at 128, have been dropping a bit to 125. That's not a big drop and not enough to cause a reversal of columns in this chart. But if it continues to drop, a number in this rate of change chart down to 122 would be a reversal back down, and that could indicate that the movement from the October low to the high this month was just a short-term movement, not the beginning of a major new bull cycle. At the same time, a push through this August high if the market's able to regain its strength, and in March and April continue to push higher. If it breaks that high, that would be an indication that the low in October was something more meaningful and a opportunity is setting up. And over on the relative strength chart, you could see not exact, but similar type of pattern coming right up to the August high, and now it has stalled out as well. Now, in addition to those particular charts we just looked at, John, in our last couple of strategy updates, pointed out our vital signs that we watch, which are 7 different indicators that track the progress of a new buy signal. And we're seeing a very mixed picture there as well, with about half of those showing a pattern that is similar to previous successful buy signals, indicating that there's a longer-term trend in place. About half are showing patterns similar to buy signals that did not develop into long-term trends. So the jury's still out, and more than likely the next couple of weeks could prove to be critical in that determination as to whether we're going to get follow through to the upside, or there's a reversal in place and the bear market tendencies are taking hold once again. Well, as has been the case since this buy signal developed last November, we've been navigating the markets with conflicting signals. The market model turned up, yet our economic model has remained negative throughout this period. And I want to share a little bit of update with you there that I think you'll find interesting. All right, so here you can see one version of our economic model, the monthly leading index. These indexes and leading indications continue to point down. And in fact, if we look at the latest reading for the blue line, which is a very long leading economic indicator in terms of warning of a recession, it's deeply negative. It hasn't been this negative since the early 1980s. The red line, which lags the blue line but still is leading the economy itself, is also continuing to move down. So this isn't new, just an update with the latest numbers, and in fact we'll get our January read next week, and we'll update you if there's any material changes that take place. And if we look at the weekly leading economic index, similar story to our last look. Again, bit of a stall in the decline there, but nonetheless, we're into negative territory. Generally speaking, when we get this deep into negative territory, we're bound to move into recession at some point. I want to share with you some additional economic data that we've been tracking, and it just recently turned negative. This is a component into the leading economic indices that we just looked at, but just one component, and that's housing starts. And what we found is that just recently the housing starts have dropped enough to get a crossover. The red line dropping below the blue line, that's a meaningful indication in the past, warning of a recession to come. Well, that happened now, just beginning with the January housing numbers. We now have the February housing numbers. It's continued to slide. So this one is now pointing towards a recession as well. And when we looked in the past, the lead time to a recession was 8 to 9 months. So with it moving negative in January, Again, pretty wide dispersion of the previous indications, anywhere from a couple of years ahead of time to even very, very close within a month or two prior to a recession. But the median or mean time is about 8 to 9 months, which would indicate a recession beginning in September or October of this year. So the economic numbers continue to look dire. The meaning behind that is if we head to recession, more than likely there's going to be another leg down in stock prices due to the recessionary impacts on corporate earnings, on the consumer, on the jobs market, etc. The question still remains, when will the recession start and how long out into the future is it? When we got the buy signal in November, we speculated that perhaps the recession, which was being warned about at that time by these indicators, is still far out into the future. If it didn't happen until late this year or early next year, it gave the market a little bit of runway to potentially make a move that would have been an opportunity to accumulate some wealth. That's still a very good potential, but if that recession is getting closer, then it shortens the window. And if the recession begins, say, in May or June or July, we may have hit the peak in the market in February. So from our perspective, it's not a matter of if we'll have a recession, it's a matter of when. And as we get closer to that time developing, it puts the potential of a reversal down in our market model at some point coming back into play with our decision making. Now, there's one additional thing that I think makes sense to continue to remind you of, and that's the seasonality tendencies based on the presidential election cycle. We still are very squarely in a strong seasonal pattern, which is the third year of a presidency. You could see the far right columns indicate the average two-quarter market performance. This is the strongest two-quarter market performance. We're in the first quarter of the third year. The next one is the second quarter of the third year. So we still have very strong tendencies based on the election cycle at this point. And if we go look at what the weakest one was, the second year, which of course was last year of the Biden presidency, and the third quarter, well, that's right around when the market hit its bottom. So it seems like the seasonal tendencies are holding true to form, meaning it wouldn't surprise me in the least if this weakness we've seen develop in the stock market is fleeting, and as March, April, May roll around, we get some additional strength to build. With last year being a midterm election year, we talked often about how there's a long history of big declines in midterm election years. Last year was not an exception, with about a 24% drop in the S&P 500 from the high to the low. The second takeaway is 1 year from that low, the median performance in the S&P 500 is up 27%. Well, that low came in October, and we're currently about 13% above the low, meaning that there's potentially some additional room for the market to continue to rise if it's going to continue in this seasonal tendency. So as you can see, there's choppy waters to navigate. There are a lot of cross currents. We're going to continue to use our proprietary models to navigate those cross currents. We want to capitalize on opportunities if they develop, but we also want to remain flexible to move back to wealth preservation if our market model turns negative again and there's another sustainable leg down in the market. Well, that's going to wrap up this update. Thanks for watching. Have a great weekend.